let's discuss the markets. It's time for more market chatter. Now with Andrew Holland, the CEO of Avendus Capital, joining us live right here on ET Now. Good afternoon, Andrew. Always a pleasure chatting with you. We're seeing a lot of red on our screens. I know typically you like to see red only when it comes to Manchester United, which also declared a result in the red, blaming it on Donald Trump's tax policies. But jokes apart, you have been saying in the past you're not at all surprised by the global sell-off, that you had predicted this. I don't know if you're the next Nouriel Roubini in the making, but why did you predict that? And do you think there's more pain in the global markets, which will obviously not augur well for the Lal Street?
See, markets these days discount things very quickly, and whilst I'm saying that the volatility will probably remain for a few more days, if not maybe for nearly maybe one more week, you've got to say is it starting to discount some of these factors, and my answer is probably yes. So I'm not overly bearish because I think global economy is fine. And that's probably where the problem is that it's too good, and obviously interest rates have to move higher, which is what's been kind of expected now. Maybe more aggressively in the US, particularly from the UK after yesterday's monetary policy, and now Europe. So I think the reality of that is starting to dawn on people. I think the other thing that if you look over the past year, is that that bull market in complacency, I think, which we've all experienced, is probably over for the time being, and I think that's not a bad thing. So if anything, I think all the excesses is being taken out of the markets. We're getting to a little bit more reasonable valuations, but I don't see that you're going to see. You might see a bounce up, but it could be a little bit more kind of slower than in previous years or previous times. Because you don't have the backdrop of the central bank, with kind of adopting easy monetary policies. Because if they get behind the curve too much, then it's going to be very big aggressive interest rate hikes they'll have to make as growth continues and inflation rises. So that's the dilemma for the market, and what you have for the first time in a little while is competing assets. So obviously with bond yields moving higher at some point, those will become attractive versus equities in terms of dividend yields as well. So that's the difference, I think, this time around when we look to when the markets recover. So yes, a lot of damage has been done, excess is being taken out, but I think the good news is that people now remember that there are risks to markets as well.
You said it's like a bouncer, so in cricket analogy, is it a yorker, is it a strikeout? Are we in a bear market? Maybe too early to say that. Most predictions saying that no, this is just a correction. Andrew Holland also saying that. But Andrew, everyone who's watching you right now wants to know, in this market, how do I make money? So that's my question to you. People who want to enter the market are already invested in market right now. And please don't keep it as vague as be stock specific. Do you have any specific ideas on how one could make money with so much volatility and not knowing what's going to happen the next day unless you watch Wall Street very closely?
The best way to answer that is how to save your money, and how to save your money is just let the dust settle and sit in cash. Because you could very well buy into the market today only to see that Wall Street has another horrible night, and then you come in Monday morning and you're sitting on losses. So why not just let the dust settle? Protect capital in these kind of volatile times is my advice, actually, for people. But if let's say the dust settles and the market rises, I don't know, you miss the first 2-3% in a larger rise going forward, why would it matter? It doesn't really. So I think rather than try and time the bottom or try and find where it is, you just wait. There's no harm. I mean, we might be talking about just a couple of days or possibly a week for the dust to settle, and that's what it will be.
Andrew, hi, Siddharth joining in conversation. Now, I'm not comparing this correction with 2008 or 2011. 2008, we had, subprime to blame. 2011, everyone spoke about, how China and commodity is the reason why we saw that correction. But this time, people are talking about rising bond yields because US Fed is going to increase the interest rates. People are also talking about weak dollar. But that input or that parameters we were knowing since last probably couple of quarters. So today, as you know, as a viewer of market, and there are a lot of people on our channel who want to know that what has hit the market, what is the key reason for this market to correct. And the second question is, you are now into alternate investment option also. Apart from buy and hold, that is long only strategy, what are the different strategies you are adopting in your fund?
So, what triggered the fall is difficult to pinpoint exactly that, because as you rightly say, all of those factors were there. And, they've been known for some time, and we've been concerned about them for some time. But, I'll go back to and repeat myself for many times before, is that in liquidity-driven rallies, you don't know quite what it's going to be, but something will burst that bubble. And it could be a combination of factors. So it could have been, interest rates rising in the US or bond yields rising in the US, plus also, the tax cuts in the US will obviously give an extra fillip to the economy, and along with wage growth, which is the first time you've seen wage growth, kind of expand at the rate it was. So it could have any of those combination of factors, could have just brought the end to the party. But I think the complacency was probably the biggest factor, which has probably just been dislodged for the time being. In terms of our own fund, which is the largest Category 3 hedge fund in India, obviously we can go short and have protection, and that's what we've been doing over the course of the last few months. Is just waiting for that rainy day to come, and when it does, it gives you some cushion for the market fall. So it's a matter of sometimes sitting there when markets are rising and being a little cautious, leads to not as great performance, but it saves you in the bad times.
Before we let you go, the free run of the markets in that sense has ended with the reintroduction of the long-term capital gains tax. It's only 10%. You cannot blame that for what's happening on the markets as well. But just to take forward this entire conversation, would you still believe that equities is the best asset class? You said save your money, but if you had money to spend, would you say that it's still best to put it in equities? Could it be real estate, which may be at its bottom? The government seems to be quite serious about gold as an asset class. It was touched upon in budget 2018. I don't think we can discuss bitcoins. The tax fan is very against it.
Yeah, well, disregarding bitcoins for a second, because no one seems to like them, there are competing asset classes now, which there wasn't, there seemed to be no alternative, right? That was the thing. It's only equities. But perhaps this the recent pain will remind people that you can also kind of see lower returns going forward. And I think that's the thing with the capital gains tax, is that you are going to see lower returns, because obviously you're going to be taxed on part of it. And I think once that realization comes in, then depending on where our bond yields go in India, there could be a competing class there of 7-8% risk-free, which people might like. That yes, they will be locked in. I think the other point is, and it's an important point, and I think there's a lot of confusion out there in terms of, should you sell now and book your gains? Because if you don't, and then you do it after April, you can't, or you lose money after April, you can't take forward your capital loss. There's a lot of confusion out there, I think, for retail investors of what they should be doing. And if it's not kind of addressed in some point, I think you'll find maybe just a wave of selling as people just say, okay, I'll take my profits now and I'll see what I need to do thereafter.
Always a pleasure chatting with you. Thank you so much for joining us with your outlook on where the equity markets are headed and what people can do with so much volatility and the kind we haven't seen in recent times.